Tesla moves forward after all. Goldman finally gets out of retail, and everyone's trying to figure out where inflation is headed. This is Bloomberg Wall Street Week. I'm David Weston. This week, Wes Edens' Brightline breaks ground on the nation's first truly high-speed train line.
This is now the beginning of the high-speed rail industry in the U.S.
Sir Clive Gillinson of Carnegie Hall on what it takes to make one of the world's great concert halls not only survive, but thrive.
You always go for the vision, go for something that is irresistible.
And Tony James of Jefferson River Capital on making sure New York's Metropolitan Museum of Art doesn't turn into your grandmother's attic.
We're trying to be current. We don't want this to be your grandmother's attic.
We start with the ever-present question of inflation and where it's headed with Peter Borish, Chairman and CEO of Computer Trading. So, Peter, welcome back. Good to have you here. Every week we get new data on inflation, points one way or the other. But in a larger sense, you often look at what you call the 7 C's in commodities. What are those telling you right now?
First of all, thanks for having me. The 7 C's are relatively consistent that inflation is going to be persistent for longer. You're starting to see some of the seasonal commodities potentially break out. Cattle, 1 C. Corn, the other C, that have been relatively weak. The stronger C's, coffee, cocoa, and crude, they've been relatively stable after having fairly large moves.
And what's driving that right now? I mean, what are the forces? Why do you look at the 7 C's?
I look at them as the AC, which is the consumer. And in terms of, is the consumer going to have to substitute their spending for more on staples where demand is inelastic, and that then is going to lead to less discretionary spending across the board. And so then I look at bigger picture stocks like Visa, MasterCard, Costco, Target, to see if the consumer strength is still there. Those stocks have demonstrated a little bit of weakness, so that is the conundrum, the 9th C, of the pressure on commodities and potential weakness of these consumer stocks, which definitely puts the Fed in a box.
So if there's a breakout in some of the C's and the commodities, that puts pressure on Visa and MasterCard because people don't have as much money to spend at Target, for example. They have to spend it on food.
Yes, yes. And so those stocks in particular are a good measure of consumer strength, and you see that in weekly data that you can get from JP or Bank of America, compares it week over week or year over year as the strength of consumer spending.
Now, some stocks that have really felt a lot of pressure just recently have been the big tech. What is going on with them, do you think?
Well, first of all, there's the trading aspect to it. So, you know, there's the old saying, right? What goes up must come down. So you've basically had a really big move. You've corrected. Technically, a number of these stocks have broken key levels. And if they don't reject those levels and start their uptrend again, that could mean that the leading aspect of the technology relative to other stocks is ending, which can hurt the large cap indices because they're such big weights.
What does this all say to the Fed? I mean, I could speculate that actually a little bit of tightening financial conditions would not be a bad thing for the Fed right now because they've been going the other way.
I think the Fed is sprinting in place. Very, very challenging because you have this tug of war. But it's hard to say that you should be easing when you've just had record highs in Bitcoin, record highs in equities, and you've seen gasoline prices go up and potentially now these other commodities breaking out. So they're stuck, in my mind, of not doing anything probably the rest of the year.
gold doesn't begin with the C, last time I recall, but you talk about record highs. We've had some record highs in gold. Is that a useful indicator in your experience over time of where inflation might be heading? Because often you think that's where you go if you think you got inflation.
So I am not one that particularly favors gold as an indicator of what's going on with inflation. By the way, the correlation between gold and the S&P has been fairly high, so you would think, oh, that's a cross current. People tend to look backwards. So in the 70s, when gold was really strong and inflation was high, there weren't really a lot of other instruments to use to hedge against inflation. But today, there are many more instruments. You can short bonds in the futures markets. You can participate in individual commodity markets, or you can actually participate through options or futures in the equity market. So I don't think gold is as much of an inflation indicator as perhaps a supply and demand question for uncertainty in the global geopolitical, and then non-U.S. central banks may have added to gold demand recently. Of course, that too, in the last week or so, has had a pretty significant correction.
Let me come back to your ninth C, I think it is, conundrum, what you said.
Yes.
Okay, as an investor, how do you invest into a conundrum? What do you do?
So it depends on your time frame, right? If you're younger and you have a long time frame, then you sit back, and that's the nature of markets. On average, right, there's a double-digit decline in the S&P every year. Of course, I'm always mindful of the 6-foot-tall man that drowns in water an average height of 5 feet. So you have to be careful of averages because there are bear markets. But in that case, you stay the course. If you're more like me and you're a trader and you've had a good run, I think the hardest thing in portfolio management and discipline is selling a winner or taking it down and rebalancing your portfolio. Is this a time to rebalance your portfolio where you have this conundrum combined with Fed uncertainty? I think that makes a lot of sense.
Peter, it's so helpful. Always good to have you on Wall Street Week. That is Peter Borish of Computer Trading. Coming up, government subsidies. China's long embraced them. The United States is getting into the game. Is Europe next? We ask Bloomberg Senior Executive Editor for Economics and Government, Stephanie Flanders. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Treasury Secretary Yellen traveled to China to criticize the government for subsidizing parts of its industry. But this week, the IMF leveled a similar criticism at the United States and urged Europe not to follow suit. To take us through where Europe stands in the apparent race to subsidize, we welcome now Stephanie Flanders, Bloomberg Senior Executive Editor for Economics and Government. So, Stephanie, welcome back. Great to have you with us. So tell us about this wonderful world of industrial policy. I mean, sometimes we criticize it, and it looks like right now the United States is embracing it. Where are we globally on industrial policy?
You know, this is one of those things where it's a fast-moving bit of economics, certainly of economic policy making. You know, for decades, certainly when I was first learning about industrial policy and economic policy, it's kind of a dirty word. Certainly, capital I, capital P industrial policy, because it was the idea, maybe more popular in the 50s and 60s, that governments could spot strategic industries and invest in them. And the line I was always given that they were good at picking losers, they weren't good at picking winners, and that you could waste a lot of money doing that as a government. And if you were going to do it successfully, well, the only places that had done that were maybe places like Korea or Singapore, where you had highly effective states and you had, you know, these were emerging market economies that had a path to follow. They could see what other countries had done, so they had less chance of getting it wrong. What's changed, I think, you know, like so many things, has been upended by the different geopolitical outlook. You know, that what you think of as imagines even, what a winner would be in a context where you could have in 10 or 20 years' time a decoupled global economy really changes. It could be you may have wasted a lot of money, and an economist might have said that is a big, you've inefficiently used those resources, you're not making profits, you've produced excess capacity of a good in the global market from doing this industrial policy. But if in 20 years' time you find that you're the only place with, say, a solar panel industry on one side of a big economic divide in the global economy, well, maybe all that quote-unquote wasted money will turn out to have been well spent. So I think everyone's having to kind of rethink what success and failure looks like in an industrial policy context. But we certainly could be in for wasting a lot of money with these subsidies.
Whether it's a good thing or a bad thing, how much of this do you think is triggered by China? Because China is now the second largest economy. Some things it may be on its way to first. It's certainly embraced subsidizing industry quite a bit. The Biden administration criticizes China a great deal for that. But it's an enormous amount of money. How much of it is the rest of us being afraid that they will overwhelm us?
Well, and I think it's not just the fear, right? It's actually the reality in some key sectors. I mean, the green technology is a classic example. We're now looking at how much, Chinese EVs, electric vehicles, are just sort of swamping the global market. A lot of subsidies have certainly gone into that. The European Union announced an investigation into EVs. They've already been burnt when it comes to solar panels because the European Union had invested a lot in wanted to have a big domestic solar panel industry, was just wiped out of the water by China. There's the sheer scale of Chinese production. Now 90% of solar panels in Europe are made in China, and actually a very high proportion in the US as well. So, China is driving this, but of course, if you're Europe, it's also the Biden administration's response to China, things like the Inflation Reduction Act. The Europeans have felt like they had to have their own thing. They announced the Net Zero Industry Act last year. It was very explicitly about building the European domestic green energy systems and products so that they weren't going to end up reliant on China.
And how much pressure is there on Europe? That's what the IMF warned about, that they thought that Europe would go that direction, warned that was not a good idea. They're better off breaking down some of the trade barriers that they already have internally. At the same time, there's a general perception that the European economy is not as efficient, is not as competitive as the U.S. economy and maybe some others right now. Do they need to do some sort of large fiscal infusion to really get competitive?
I mean, I suspect certainly the International Monetary Fund would say it is as much about developing the single market and working as a cohesive block as it is about spending lots of money. Yes, there's going to need to be a lot of investment funds for green technologies, for decarbonising the economy, potentially for taking advantage of digital technologies that Europe hasn't been able to do as well as the US.
So a basic principle of ethics that I learned back when I was in college was ought implies can, which is to say you ought to do something, first you have to be able to do it. When you say you have to kind of competitively, Europe to the United States, can it do it? Is it possible? Or are there structural factors that really mean that it's never going to catch up?
Well, I think even the philosopher Immanuel Kant wasn't quite sure whether ought implied can. And certainly when you're a policymaker, you often find that ought does not imply can at all. If you're a voter, you often find that. So, I mean, clearly Europe, as I mentioned, has been trying to do this stuff for a while. I think it is interesting that they're focusing, particularly when they're talking about investing in green technologies now, their minds have been focused by what has happened with China, the fact that they've basically lost the battle on solar panels. So they're thinking about how can they invest in a smart way, not completely matching China on scale, but maybe matching or exceeding it on quality, innovation. Also thinking about how they work together. So individual countries now, if they're all warring against each other, battling subsidies against each other, that's obviously going to be a disaster.
Is there the political will in Europe to really become more competitive economically? Is this a political issue that's on voters' minds?
I think it's always one of those things that is talked about a lot in Brussels by the European Commission. Always sounds a bit boring, even the phrase European competitiveness. I mean, voters have heard politicians talk about it a long time. An even worse one is Capital Markets Union, which they've been talking about for literally years, decades. But, you know, if you have the kind of pool of investment capital that you have in the US, you're not just relying on bank finance, which obviously is the dominant source of funding for companies for investment in Europe. You know, that does open up a lot of opportunities. So I think voters understand that the green transition is a big deal, decarbonisation. They're worried about the costs of that. They understand that maybe a more kind of European energy market might be a good way of doing that. They certainly notice the number of Chinese EVs on the streets of Germany, of France, of all these countries. Whether they're really ready to make sacrifices for that is less clear.
Stephanie, it's always so good to talk to you. Thank you so much. That is Bloomberg's Stephanie Flanders. Coming up, is America finally going to get one of those high-speed trains we've envied in France and Japan? We talk with Wes Edens about his bold new Brightline venture that broke ground this week.
We think that the adoption rate for it is going to be rapid.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The United States took a big step toward high-speed trains this week when Brightline West broke ground on a $12 billion project to build a rail link between Las Vegas and Los Angeles. And we welcome now the founder and chairman of Brightline. He is Wes Edens. Wes, great to have you with us. Thank you for joining us. To tell us about this project, Brightline West, it's the second Brightline project after Florida. Give us a sense of how big a business this is in success.
Oh, first of all, thanks for having me on, David. You know, it's a great time for us. It's a great time for the rail business. And so we, as you said, we broke ground earlier today on Brightline West, which is the second train project for us. But it's most notably, it's the first high-speed train, true high-speed rail that'll be built in America. And that's a big deal and a monumental occasion. And I think actually even a bigger deal is I really do think that this is now the beginning of the high-speed rail industry in the U.S., which I think has got, you know, massive, you know, opportunities and growth in front of it. So it's a really exciting time.
Given your investment tracker, you've checked how much demand there is out there potentially, and you've concluded it's big enough to support this and make it a good business. How much demand is there?
You know, there's about 50 million trips that happen between Los Angeles and Las Vegas every year. About 85% of those happen by car. And I don't know if you've ever done the drive from Las Vegas to LA, but it's a notably difficult drive. It's probably 4 hours in the best case. It's very, very unreliable in terms of what the time actually is. And so there's a tremendous amount of demand between these two cities. There's only one way to get there, which is on I-15. And so our train is going to go right down the middle of I-15. And we think it's going to have a massive amount of demand from people that make that trip.
This is not your first foray. You have Brightline up and running in Florida, right, between Miami and Orlando. What have you learned from that will change what you do in Brightline West?
Well, I'd say most notably we learned that people like trains, right? So we have millions of people that ride our train down there. The adoption of it in South Florida and now up to Orlando has been terrific. We opened the route from Miami all the way to Orlando recently. It was actually last September. The numbers have been fantastic, and we're very optimistic about the future of that train. The biggest lesson I'd say is that when we built that train, we basically used the existing rail corridor for a portion of it. So basically from Miami up to Cocoa Beach, it's kind of a straight shot from south to north. At that point, you turn left and then go across Route 528 to the Orlando airport. That's how the route is made. What we did, you know, that because we had access to the train, it was version 1.0, as I said, it makes a lot of sense. But there's a lot of things about it that we think can be improved on. In particular, there's a lot of rail crossings there, because it runs up really US Highway 1. So this train from Vegas to LA will site it in the middle of I-15. It's a big 200-foot wide corridor, put it right in the middle of it. And because of that, you can put a fence around it, you can electrify it, no rail crossings, you can go true high speed. So, you know, north of 200 miles an hour is kind of the objective. And that version 2.0 is what we think makes sense for this corridor. And I think it's a good blueprint for what we should find success with in other parts of the country as well.
What's the time horizon you're looking at for these investments? I believe you're cash positive in Brightline out in Florida now. You haven't recouped the investment yet, but you're cash positive. How long until you actually recoup investment in Brightline, or for that matter, Brightline West?
I think from this point forward in Brightline East, it's all systems go. We're adding more capacity this summer in June with more train cars, the same in the end of the year in December, and the same again next year. And so with that, you'll then get to higher ridership levels, higher revenues. And we think that that's a time in which we'll start to look at, different alternatives in terms of financing, bringing in equity, et cetera, et cetera. Brightline West is a bit of a different situation in that it's a unitary train line that goes from LA to Vegas. So, and as I said, there's 50 million trips that happens on that route already, most of them by car. So we think that the adoption rate for it is going to be rapid once it's up and running. And I think that the capitalization for it is also gives us a lot of alternatives as a result. But I think that not only the train be incredibly popular and satisfy demand and be green and safer and all those things, I think it'll also be highly profitable and a terrific investment. I'm a big believer in it.
Do you have a sense of when you would bring in other investors, either equity or debt?
Yeah, we have brought in, modest investors. I mean, I'm a large investor in it personally, so I'm a big believer in it. I kind of eat my own cooking, so to speak, with it, and have for a long time. I think that it's an investable, project now, and so the groundbreaking today, I think, signifies kind of the next layer of it, and I think that there will be some investment opportunities both in the debt and equity side in the upcoming kind of months between now and the end of the year. And then I think as you get under construction, I think that there's lots and lots of different opportunities to grow the business, because this is something clearly can be replicated at other city pairs around the country.
Tell us about the government role. We had Secretary Buttigieg come out for the groundbreaking for Brightline West. How critical is the government? Can these happen without the government really supporting them?
I think in the long term, the answer is absolutely yes. But I think that there's lots of examples of government playing pivotal role to getting new industries off the ground. So if you look at the history of Elon Musk with his SpaceX, or the electric vehicles, or subsidies for the solar business, there's lots of examples of things that started out being subsidized and then turned into be big, robust businesses. And I think the train is going to follow those same footsteps. So when you say government, there's many governments involved. So it's really a coalition of local governments and state governments and federal governments, all of them playing a big role. Obviously, the federal government and the Department of Transportation, providing a $3 billion grant was a huge part of this. But frankly, so were the delegations from Nevada and from California. Frankly, the governor in Nevada, Governor Lombardo has been an incredible supporter. The DOT, the Department of Transportation, is our partner in Nevada for this project. So, I like to think that it takes everyone to say yes and only one person to say no to derail these kind of projects. And fortunately, we have such a compelling project that we've actually had nothing but yeses. So it's a really good position to be in.
Assuming continued success, where next? And particularly for those of us in the Northeast, is there any prospect of this ever happening in the Northeast?
You need a kind of a unitary corridor that you don't share with anybody else. So the Northeast, obviously, the Acela route from New York to Washington and New York to Boston is incredibly popular and is actually quite profitable. So that's a great thing. To go at the highest speeds, you'd need to have a little bit more of a confined corridor, if that makes sense. So when we think of the places that are likely to be next on the list, it's city pairs that have got the same characteristics as we see here, which are two big population centers separated by 200 or 300 miles, lots of travel between them and lots of traffic between them. So, Atlanta, Charlotte, Dallas, Houston, San Antonio, Dallas, that whole triangle in Texas is one, Portland, Seattle, Chicago to St. Louis. There's lots of different expressions of it. And I think that the successful launch of this will be the beginning, not again only of the next rail system, but of the rail industry. Because I think in this country we have a big automotive industry, we have a big airplane, aeronautical industry. I think it's time to have a big passenger rail industry. And it could be, hundreds of thousands, if not millions of jobs, lots of the technology we deploy in other ways in this country deployed here. And I think my view is that the lasting legacy of this event today and of the rail is not only the rail system, but more importantly, the rail industry that's likely to follow.
Okay, Wes, thank you so very much. That's Wes Edens. He's chairman of Brightline and Brightline West. Coming up, the arts are at the center of who we are, but many venues across the country have come under increasing financial pressure. We traveled to Carnegie Hall to hear from its leader, Sir Clive Gillinson, about what it takes to make a great arts institution thrive, not just artistically, but financially. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The arts, including music, museums, photography, and more, contributed over $1 trillion to the U.S. economy in 2022, according to the Bureau of Economic Analysis. And New York in particular is known for its performances and museums. But the very nature of the arts is going through fundamental changes in what is presented and in how it is paid for. Changes triggered in part by a pandemic that forced most of us to stay at home. Sir Clive Gillinson has been the executive and artistic director of Carnegie Hall for nearly 2 decades, and he remembers well the dramatic moment when his legendary concert hall was once again open for business.
One of the most moving things is when we opened again after COVID, the emotion in the hall was astounding, because Robert Smith, our chairman, and I thought we should speak to the audience on the opening night. And I literally said the first 2 words, which were "welcome back." The place exploded.
Welcome back to Carnegie Hall.
And that emotion has carried through. So, firstly, I think the whole thing of live music and the impact of live music, that is in the greatest possible shape. And, you know, and people love it, care about it, and I think they, even today, that emotion is still there about how they now value it in a way where you only value something when it's taken away from you.
Are you, Carnegie Hall, fully back from the pandemic?
Yes, the first year we had a reduced number of concerts. Last season and this season, it's the full number of concerts. We're back to the normal number of presentations. And audiences are averaging 93%. So we're, I mean, you know, fantastic response to what we're doing. And there's a real feeling of engagement with the music in a very powerful way.
It wasn't just performing arts centers like Carnegie Hall that were hit hard by the pandemic. Tony James of Jefferson River Capital serves as co-chair of the Metropolitan Museum of Art, a position he came to when the pandemic hit, and hit the Met particularly hard.
The Met, for example, lost $100 million of revenues over the 2 years. So that's hard to recover from. A lot of the art scenes in New York depend on tourism. Our attendance from locals are all the way back. Our attendance from tourists are only in the 70s. And particularly Asian tourists. That's where we're really short. And so it's a bit of a struggle. We've had to find new revenue sources. We've had to be careful about costs. But I think, you know, as we've discussed in the past, David, I think arts are what make New York the gateway city, the wonderful city that it is.
The success of a great arts center like Carnegie Hall or the Metropolitan Museum requires a balance between high culture that appeals to changing audiences and running a very large business with all the challenges of managing costs and attracting revenues that any CEO of a big, complex company would understand. One of the things that strikes me is your title. You're executive and artistic director. It reminds me a little bit about the division between a publisher and an editor in a newspaper. You have both. You're responsible for the business, as it were, of Carnegie Hall, as well as the artistry. Give us the sense of the balance. How do you get the right balance between the business side and the art side?
I mean, it's a really interesting question because most organizations separate the two. The reason I would never, ever do a job which was half of what I do is because I feel if you're involved in the artistic, you want to be as expansive and imaginative and take risks and, you know, and really travel extraordinary journeys with the music. Now, if you're the person responsible for the money, you're probably going to be cautious and keep saying, I'm not sure we can do this, I'm not sure we can do that. The good thing about doing the two together is if I want to dream, I've then got to be part of making sure that can happen as a business. So in a way, I think it enables you to take far greater risks because you're responsible for both.
You've been known throughout your career for taking some risks. I mean, you were, of course, a professional cello player back in the London Symphony Orchestra.
Well, that was somebody else's risk, having me as professional cello player.
But then you stepped up, not necessarily volunteering, but you stepped up to really take over a struggling organization, and you took risks from the very beginning. You've taken risks at Carnegie Hall. How do you get the right balance between taking a risk and, as it were, not falling off the high wire?
Well, I mean, of course, the key thing about all risk is how you manage risk. I mean, you can't live without risk. And so, you know, there's a famous saying, which is, you know, if you're not living near the edge, you're taking up too much space. Money follows vision. You always go for the vision, go for something that is irresistible, that has to happen. And then there's a chance you can sell it to somebody else. If it's good and the world can live without it, I mean, it's very nice for it to happen. If it's only that, it's very hard to sell to somebody else. It's got to be irresistible.
Over at the Metropolitan Museum, Tony James says that the mission is to show the world great art. But to do that, it needs to generate a great deal of revenue each year to support the facilities, including the 2 million pieces of art the Met owns, only 15% of which are on display at any given time, and to mount more than twice as many exhibitions each year as any other museum in the world.
About 30% of our revenues come from people paying to go in, buying food, buying stuff in the store. So let's just call that revenues, members as well, that pay dues. So that's about 30% of revenue. About 30% of our revenues comes from spin-off from the endowment. We'd spend about 4.5% of the endowment each year, but that's very restricted because people give, I'm giving this money, but the interest on it can only be used to buy Renaissance art or something. There's fun digs in Egypt. There's all kinds of strange things. And then about 40%, the remaining 40% comes from contributions of different sorts and benefits, but charitable giving. The problem the Met has is, one of the great things about the Met, depending on how you want to look at it, we sit on city land. It was given 150 years ago, but we sit on city land. And the deal was that city residents can pay what you wish as you come in. So the average city resident pays less than $10 to come in for one of the biggest museums in the world. They can spend days there or weeks there, and whereas a tourist pays $28. And so when you lose your tourism, you lose a lot of the revenue-paying people, honestly. And so that's been a challenge.
What about the donation side, the philanthropic or charitable donation side? By the way, how much of that is from corporations as opposed to individuals?
Very little from corporations. I gather Clive Gillinson's done a better job than that, perhaps, than we have. But ours is almost all giving, individual giving, with a little bit from the city as well.
And that key role of the donor in supporting the revenues of Carnegie Hall or the Metropolitan Museum is one way that art centers are very different from any for-profit corporation. They need to pay attention to their appeal, not just to customers, but also to those making charitable contributions each year. And the reasons for those donations can vary every bit as much as the particular interest of each person writing a check.
How people give money and who gives money is never decided by us. It's always decided by the donor. And so, the whole thing about raising money is you've got to share vision and share the things you believe in. Now, if somebody doesn't believe in those same things, they're not going to give you money. So I think the donors have changed enormously because what we do has changed enormously. The wonderful thing about the board, about the donors, is they're passionate about what we do because they don't need to give money. They only give it if they care and if they're excited about what we do.
Talk to me about costs. How have costs changed over time? To what extent are you falling prey to inflation the way the rest of the country and much of the world is?
It's a business like any other business. And I remember a businessman once who was on my board in London, in fact, saying, people think that the arts is a luxury. He said, the way you have to run your business is much tougher than I have to run my business because you have no margin for error. Big businesses, which are purely commercial businesses, have much more margin for error. And if they make a bit of a loss here or, a huge amount there, they can balance it all out. Essentially in the arts, you have no room to move. You've got to always be on top of it financially. So it's hugely demanding in terms of the business and has to be, because if you can't make it work as a business, then you're going to fail artistically. So, it's one of those things where I think people assume the arts are not about a business. In point of fact, they have to be incredibly rigorous businesses to be great arts institutions.
Coming up, we'll take a closer look at how centers of art and culture are changing what they present to adjust to changing audiences and what lies ahead in an increasingly digital world. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. There's more to sustaining the cultural center of New York than presenting great art. Institutions like Carnegie Hall and the Metropolitan Museum must respond to the changing city and culture around them, reaching out to new communities and adapting to the new forms of expression that the digital world makes possible. And perhaps most of all, using the art to tell compelling stories for all of us.
We have transformed the hall. Firstly, we do much more storytelling. We started big festivals when I began, and one of the earliest things was I asked Jesse Norman, an extraordinary singer, to create and curate a series about African American culture. And we've looked at a number of big stories. I mean, we've looked at migrations and how migrations created American culture. We've looked at Afrofuturism. We've looked at the role of women in music, but more generally across the whole of culture. Now, currently, we're looking at the fall of the Weimar Republic and using that as a lens to look at the fragility of democracy all around the world. Big issue of our day. Next season, we'll be looking at Latin music. So, a huge amount of storytelling, and that's only one dimension.
I suppose if you're a tourist and you've never seen Van Gogh's haystacks, you want to go see them in person. But because so much of our audience is local, and we want them not to go once a year or once every 3 years. We want them to go every month. We want them to come back. So we have to have things that they want to go see that's current. I just got back from Berlin last night, as you know, and they've got a wonderful contemporary art museum there, and it's got beautiful paintings, one Picasso and one Magritte and this and that. It's a lovely collection of random, if you will, but very high quality contemporary art. But there's no theme to it. There's no story. We're trying to create things that have a story so that people want to come. Oh, this is, the rivalry between Degas and Manet and how they fed off each other. And they were both friends and at one point enemies. And how Manet cut Degas out of one of the paintings. And get them interested in the narratives. And the Harlem Renaissance Show has been a huge success of celebrating that whole wave of culture that's centered in New York about the strength of Africa and the wonderfulness of African American culture. That's been spectacularly successful and was not very well known. That's what gets people's interest. It's not just seeing an object.
As important as it is to preserve the best of what is time-honored in the arts, it's just that important to recognize great art that is being created to the present day and in places that go well beyond the traditions we've lived with for so long, especially as the profile of audiences continues to evolve. What is your sense of how the profile, and I'll say demographic profile, of your audiences has shifted over that nearly 20 years?
It's hard to say. We have so many audiences because we do so many different things. We're the best of every sort of music, or we aspire to be. And so, there's some audiences which are very young. For instance, our Afrofuturism audience was very different, and some up to 70% had never been in Carnegie Hall before. So, with each project, we develop new audiences and then we try and keep them as part of our audience going forward. I think the audience has grown in terms of diversity, but diversity meaning, not only race, but age, men, women, nationalities, everything. And we want to be and represent the best of every sort of music, which means that we're going to be relevant. There's something like 180 nationalities in New York. Insane. It's the most diverse city in the world. But we want to be relevant and meaningful to everybody.
If you think about what's called the Western canon of art, so the traditional art, they're all white male artists. A lot of them were from Europe. All the way back to the Middle Ages, from the Renaissance, to the Impressionism, Old Masters, not a lot of diversity in that group. And then we had sections of the museum dedicated to the arts of the Pacific and Asia, for example. But they were very discrete parts of the museum. I think the greatness of the Met is that we can integrate all these things.
If we went back 20 years ago and looked at the nature of the performers appearing on the stages here at Carnegie Hall and compared it today, how would it be different? How are you getting new young talent and where's it coming from?
Well, we all the time, part of our job is obviously to bring, the most extraordinary established performers here. But at the same time, we are always looking out for the most brilliant young players. So a few days ago, we had somebody called Yan Chan Lim who won the Van Cliburn competition. He was 19, he's just turned 20, so now he's an old man, of course. But he came in, it was sold out weeks in advance. He's a dazzling player. I mean, he is going to be part of our life for the next 50, 60, 70 years, probably.
What we think of as the traditional patrons of the arts remain key to success of a place like the Metropolitan Museum. But they're now being joined by a new, younger, and more diverse group of supporters.
We're building a new modern contemporary wing. It's going to be a really exciting project for the city, $600 million. You could spend $200 million on one Giacometti sculpture if you had to buy it. And we got to fill an entire wing of modern art. So we depend on collectors, usually at the end of their lives, giving us their collections or parts of their collections. So that set of givers is not, that hasn't changed very much. That's still not very diverse. It's old, it's predominantly white, it's very wealthy, almost definitionally. But the people that come in and give cash or go to benefits, that's young, and we make every effort to make that younger and more exciting and hipper. We're trying to be current. We don't want this to be your grandmother's attic.
For true centers of art, it's not enough to be great programmers, to present works in compelling ways that tell stories. Beyond featuring what people have already come to appreciate, they also play a key role in educating us all in what we haven't seen, what we have yet to appreciate, what is new, what is different, and what is coming around the corner.
For me, education is not about audience development. Education is about giving every child the opportunity to have access to music. So we've got programs that are all around the country and serve kids everywhere. I mean, we now reach 800,000 people a year with our education programs, probably the bulk of those outside New York City. But if those people never come to New York, I think we've succeeded as long as music can be part of their life. You know, whereas if you were looking at it as an audience development, we would have failed miserably.
So you'll forgive me, this is Bloomberg, so we like to think of the business model too.
Right.
When you talk about educating 800,000 kids, how do you support that? Where's the revenue for that?
Well, I mean, there's two things. Firstly, to create it, you have to have partnerships. So we have partnerships all around the country with people who share our values. And you can't have partnerships without shared values. So we do all of that, and then we have to raise a huge amount of money. I don't know the exact amount we spend on education every year, but out of a budget of about 120 million a year, I would have thought we spend probably at least 15 million on education, which is not much less than we spend on presenting concerts.
Like every business and institution, art centers are embracing what digital technology makes possible, expanding their reach and exposure to people in New York and around the world, such as, for example, Carnegie Hall's new streaming service called Carnegie Hall Plus, providing us the opportunity to enjoy great music in the comfort of our homes.
It's on Apple TV, it's on Amazon, Comcast, it's on 10 different major platforms, so it's available to every home in America just about now. We're also going more and more international. And my view always is, here we are, I mean, even though it's, you know, such an extraordinary city, New York, I don't know, I mean, what is it? Probably 95% of the world's population will never come to New York. So what we do needs to be available everywhere, to everybody. I never think that digital is a competitor with live. The live experience is the greatest possible experience. It's of the moment, it's being created for you at that moment, you're sharing it with other people. There's something magical and special about a great live performance, which is inspirational. But if you can't have access to that, then to have access digitally is a fantastic opportunity which we should give people as well. But it is not a replacement. So I never worry about digital being something that's going to undermine people's wish to go to live performance.
The Metropolitan Museum is also using digital technology to gain more ready access to audiences around the world. But it's also designing a new wing of the physical museum with the future evolution of technology very much in mind.
We're trying to digitize every one of our significant pieces of work in high def and make that free to the world. And our mission is to show the world great art. And it's not everyone's going to be able to afford to travel to New York. So we have to make that available to them digitally. The big question is when you build a new wing is like, what's technology? This wing has to last 100 years. So what are we building for?
But perhaps above all is the central role that the arts play in the vibrancy and health of the city of New York, something that makes it the great capital, not just of finance and commerce, but of culture that it is today.
New York, I mean, like all the great cities of the world, has extraordinary cultural institutions. They are part of why a city is a great city, because people want to come and work in New York because of the great cultural organizations. All these things work together. So I think it's a fundamental part of why New York is a great city, why it's a magnet for the greatest talent from all around the world in every way. And that is a fundamental part of what you need a great city to be.
The vibrancy of this city will depend on us getting young people that are knowledge workers. I mean, yes, we have to have service workers too, but the economic engine will be especially young tech people, programmers, coders, so on and so forth. People that want to go into finance, people want to go to creative arts, media. Those are all high intellectual content, low physical footprint jobs. That's what we need in this city. We obviously can't be building auto plants in this. So we need those people. Those people, they're highly educated, they're sophisticated, they want culture in their lives. What distinguishes New York City from Dallas or Cleveland, fine cities, or Frankfurt or Shanghai? A lot of it is the culture. That's our foundation.
Coming up, a husband's gift to his wife becomes an icon for the music world. That's next on Wall Street Week on Bloomberg. Finally, one more thought from Sir Clive Gillinson, Executive and Creative Director of Carnegie Hall, about the hall itself, how it came to be, and what makes it an icon for performers of all sorts the world over.
I genuinely think it's the greatest concert hall in the world, which is completely baffling.
In terms of acoustics?
Yes.
That's what I've always heard.
And I mean, what is astonishing is, because of the size, it's 2,800 seats. Most concert halls are 2,000.
Yeah.
And yet it feels completely intimate wherever you sit.
It does.
And people who sit right, you know, because students will sit right up where you'll see it from the platform, right at the back. And you can hear it as if it's in your living room.
Yes.
If you look
Yeah.
up
Look at
there,
that, how far
they
it is.
can hear as well as anybody else in the entire hall.
It's a mystery.
And you could have a massive orchestra making a huge noise, and it works perfectly. It can carry any sound, any amount of sound, and yet you could just have somebody playing a lute here, and you could still hear every sound.
So what goes into making a concert hall one of the greatest in the world? It turns out pretty much everything.
Well, the reality is you cannot replicate a great concert hall because, I mean, every single thing counts. The density of the plaster on the wall matters. The carpet, what the padding in the seats is. We send these seats back to Canada, to the manufacturer who made them in 1891, because nobody dares touch anything that could affect the sound. So they go back to the same place that they were made 130, whatever it is, years ago, and so on. You know, even when you have to put wires in the walls, the fact that you'll be changing the plaster, you've got to be careful that you try and get the right density of plaster.
But the unique combination of qualities that have made Carnegie Hall a legend around the world came together almost by accident, created by someone unknown as an architect who'd never done this before, to please the wife of one of the world's richest men.
And this guy had never built a concert hall in his life.
Well, one of the things I read, you can tell me if it was wrong or not, the fellow who's the architect was actually a cellist.
He was.
He played cello.
Which, of course, is the reason why he was such a great architect. He was the treasurer of Louise Carnegie's Choral Society, because she sang, Louise Carnegie sang in the Oratorio Society. There was no decent concert hall, so she said to her husband, as you do, would you build us a concert hall?
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.